Hello and welcome to this session in which we will discuss an introduction for bond valuation. But before we dive any deeper into bond valuation, first we want to know what is a bond and why use bonds? Why do companies use bonds? Well, let's take a look at what is a bond specifically. A bond is an interest-only loan. So a bond is a loan. What does that mean? It means when the company wants to borrow money, they can go to the bank and get a loan, or they can sell bonds. That's what a bond is. It's a form of borrowing, where borrowers pay interest periodically and repays the principal at the end. So basically, if you want to borrow money, what can you do? You can go to the bank and borrow. You can go to the bank and get a loan, just a traditional loan, or you can issue your own bonds. For example, a company, a corporation, are issued by companies to raise funds and take precedence over stock claims to earning. So we have a company here, and that company, they want money. So what they do, they sell bonds, which promise to pay interest and give you back your money at the end. And the, let's call them creditors, the people that buy those bonds, they give you money. That's what it is. You give them the bonds, they give you money. The bonds is a form of borrowing. Now you might be asking, why bonds are popular? Well, for one thing, they are a form of financing. They're more popular than stocks because they take a priority over stock claims. So if you remember the accounting equation, assets equal to liabilities plus equity. Well, you can raise money through debt, liabilities, which is bonds, or you could raise money through equity, which is stocks. As an investor or as someone who wants to lend or give money to the company, if you are a risk averse, if you don't like risk, you would rather buy their bonds, buy their debt. Why? Because you have a precedence over the stockholders. In case something happened to the company is required to pay you first. So from a risk perspective, it's less riskier for the lender than a stock. Now, why bonds? Also, there are many other reasons over loans. So we know over stocks, it's less risky. So why choose a bond versus a loan? Well, for one thing, you have access to larger pool of capital. So when you want to borrow money, you go to the bank. You might go to one bank, or you might deal with several banks at the same time. They can coordinate a loan. Well, even if you are dealing with several banks, you might be dealing with 4, max 5 different banks that they agree to lend you the money. In other words, every bank will take a part of that loan. For example, a $5 billion loan, each bank would lend you $1 billion. True, but they come from few banks or few institutions. However, when you sell bonds in the public market. You could sell bonds to thousands, if not millions of investors. And those investors, if your bonds are attractable, if your bonds are offering a decent interest rate, a decent return, they are going to compete over that. And if they compete over that, if they compete over your bond, that might drive down your interest cost. Whereas a loan, the bank sets the terms. So in a bond, you tell everyone, look, I want to borrow money, and I want to borrow money at 8%, just for the sake of example. If this rate is attractive to the investors, everyone's going to come and wants to buy your bond. You set the terms. And everyone means anyone with money. And this is going to increase the larger of pool of people that you can access to raise money. Also, bonds comes with bond agreement. They are usually less restrictive, especially for well-rated issuer. Remember, who sets the agreement? You set the agreement. And whether the lender wants to give you money or not, that's a different story. But usually with the bank sets the agreement. Here you are setting the terms. And the good thing about the investors, about the lenders, when they buy your bonds is they can sell it in the secondary market. What does that mean? It means if they carry the bond and they don't like it anymore, they can easily sell it. Selling a loan is a little bit more difficult because there's no secondary market. But if you buy a bond, you lend your money to this company, you bought their bond, now you don't want the bond. You can sell it. Or let's assume the price of that bond went up, you sell it. You need the money, you can sell it. So there's a secondary active market in bonds. Now in this session, what we'll do, we will determine how the bond price fluctuate because we are dealing with bond valuation. Bond valuation means bond pricing. What would happen to the bond after it's issued? So as a result of this trading, secondary market trading capability, bonds are more attractive to investors. Now that we have a basic idea, what is a bond? Why bonds are more attractive than loans, generally speaking, why they are more attractive than stocks for lenders, we are ready to dive a little bit more deeper into the bond. The first thing we are going to do is go over basic terminology, basic components of the bond. They're not terminology. I'm going to call them terminology, but they're not really terminology. Those are the basic components of a bond. Then after we look at the basic components of the bond, we would look at, you guessed it, how to value a bond and what would make a bond go up or down in value in the secondary market. This is an important topic. Let's dive a little bit more deeper. Before we proceed any further, I have a public announcement about my company, farhatlectures.com.
Our corporate finance course is best for online students and students who are taking corporate finance courses. We cover financial statements, discounted cash flow, stock valuation, bond valuation, NPV and capital investment decisions, cost of capital, risk and return, as well as other topics. Our course includes lectures as well as multiple choice questions. Go ahead and start your free trial today. No obligation. We are here to help. Your success starts here.
Starting with the basic terminology. First, we have to understand every bond comes with a face value, par value, or maturity value. Those three terms are the same. Now, I'm going to give you the easiest explanation for this. Think about you're looking at $100. On the $100 you have, it says there on the $100, it's printed there $100. This is the face value of the note. Matter of fact, let me show you $100 to tell you exactly what a face value is. And this is what it would look like. Notice here we have 100, 100, 100, 100. This is the face value of the paper, the face value of the note. Same thing with a bond. The bond comes with a face value of $1,000. And the reason I'm using the term $1,000 because in the real world, corporate bond usually, most of the time, they come in $1,000 denomination. So if it says, for example, if this says 5,000, it means we have 5 bonds assuming $1,000 denomination. If we said we have a $100,000 bond, it means this is 100 bonds because each bond is $1,000. They come in $1,000 denomination. So the face value, the par value, the maturity value is what? It's the amount that the company will have to pay back at the end of the life of the bond. Why? Because there is an issue date for the bond. The issue date could be the year 2028 and the maturity date is 2050. That just for example, for the sake of this illustration. It means in the year 2050, if you have this bond and you have a specific date, you will get the face value. The face value is the amount printed on the bond, promised to be paid. Now you're going to have to know that during the life of the bond between 2028 to 2050, this $1,000 bond could go up in value, could go down in value. And this is exactly what we will discuss today. Bond value changes. But first you have to understand what's a face value, par value, maturity value. They all mean the same thing. It means what the company will pay back when the bond mature. So for example, if the company says we're issuing a $1,000 bond, it means they are trying to borrow $1,000. Now also when they try to borrow $1,000, they may get the $1,000 exactly, or someone may pay them more, or they may get less than the $1,000. So they could get more or less money than the $1,000. Now why? We will discuss that later. If you have $100, you would always get the $100 if you sell the $100 today. Bonds are a little bit different and we will see why. This is the whole purpose of this session. Every bond comes with a coupon rate. Coupon rate is the interest rate as a percentage of the face value. The coupon rate is the reason why the investors bought the bond. When you give the company $1,000, when you give them this $1,000, assuming you gave them exactly $1,000, you gave them the $1,000 for what purpose? To get coupons. And the coupon rate, 8%. What does that mean? It means the company is paying 8% if you give them money. So what does that mean? It means you will take the $1,000, assuming this 8% annually, multiplied by, if we take $1,000 multiplied by 8%, the company will pay $80. Now, why do we call this a coupon rate? Because back in the old days, literally, when they had the bond, the coupons were attached, just like this picture. They were attached to the bond. So you will detach them. So if you are a bondholder, once the year is done and the due date is, there's a due date, once the due date is due, you would detach this coupon. You go to the company or you go to the broker and you'd say, here's the annual payment, give me $80. So you cut this coupon and they'll give you $80. How much is the bond paying? $80 or 8%. Now, if you bought 100 bonds and you're dealing with 100,000 times 8%, you will get the rate for the bonds. So the coupon rate is how much the company is paying, how much they are paying. How much they are paying? 8%. And this is important. We're going to come back and revisit this. What do you need to know about this coupon rate? This coupon rate is fixed. Once it's issued, it does not change. Because notice, think of the old days. It's a pre-printed, it's attached to the bond, it will never change. And the rate is 8%. Now, the coupon could be, this coupon could be semi-annual or annual. So the regular interest payment usually annually or semi-annually. For most corporation, it's semi-annually, but it could be annually or semi-annually. For this example, we're saying it's $80. So the coupon is $80. The coupon rate is 8%. The rate is 8%. Time to maturity. Time to maturity is the number of years or the amount of time. It could be years, month, whatever it is, until the investment is repaid. And what do you repay at maturity? You repay the face value. And that's why we call the face value also the maturity value. Because at maturity, and for the sake of this example, I said the year 2050. So at maturity, you will always get the face value. Whether you paid more or less for the bond, you'll get the face value at maturity. Then we have something called yield to maturity or YTM. This is the market interest rate required by the investors for holding the bond until maturity. The yield of maturity is what the investors wants to earn giving this bond. Now, for the year of maturity, just hold on this one because I'm going to have one separate recording in the next session about yield to maturity. It's important to understand what yield to maturity is, which is what the investors wants to earn. But that's all what you have to know for now from a basic terminology. What are the basic components of the bond? Face value, coupon rate, time to maturity. Obviously, there's an issue date, but those are the basic components. Now, let's go ahead and start to value a bond. Value a bond means what? When we pay for the bond, how much we should pay for this bond? Bond valuation. Bond valuation means bond price, and yield is how much you want to earn. So let's take a look at this picture and analyze this picture. So let's assume today I give the company $1,000. The company wants to borrow $1,000 for 10 years. Okay, great. I gave them $1,000. What do I expect in return? Well, here's what I would expect in return. On a timeline, and this is important, and here I'm going to have to mention that if you don't know the time value of money, stop right now. Stop right now. If you don't know how to do present value or discounting cash flow, go back to Farhat Lectures and look at the time value of money table, not tables. Look at the concept and make sure you know how to use the tables or the formula, because here I'm going to assume you know how to discount. If not, just stop, go to the time value of money chapter or the discounted cash flow. So when I give them the $1,000, I would expect in return, say this is 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. I'm expecting $80 for each of these periods. So each X that I am marking is $80. Why? Because every year I'm going to go ahead, detach this coupon, and I want $80. What else do I get? At the end, once all these coupons are detached, what's left is the piece of paper called the bond. Also, I will get, in addition to the last payment, so I'm going to change colors here. In addition to the last payment, I'm going to get my $1,000, which is the face value. So year 10, I will get the last payment plus $1,000. So let's take a look at this problem. What are we looking for? We're looking at two things when we buy this bond. We are looking at $80 regular interest payment of $80, which is the coupons. We're looking to get the coupons, and we're looking to get a $1,000 at the end of the life of the bond. Great. So to determine how much I want to pay for this bond, this looks like an annuity. The $80 is an annuity, and the $1,000 is a one lump sum payment. What do? I discount the bond. I discount to find the value of the bond. I discount the regular payments, the regular interest payment. I discount the regular interest payment, in my situation $80, and I discount the lump sum of $1,000. This is $80, but this is going to be 10 times. I will discount this annuity, and I will discount the face value, the lump sum of $1,000. Then I add those two figures together. Once I add them together, what do I have? I have the value of the bond. How much would I pay for this bond? Hold on a second. If I am discounting, I have to use a discount rate. This is the question here. Which discount rate I use? Here's the key to remember here. When you discount those payments, assuming you know what discounting is, assuming you know what the present value is. If not, go to Farhat Lectures and look at my discounting chapter. I believe it's the previous chapter to this one. I believe so. Otherwise, just look for it. It's in this course. So discounting. Discounting means finding the present value. If you want to find the present value, you need a rate. Which rate do you use? We are going to use something called the market or the yield rate or the ongoing rate, the ongoing market rate. What's the ongoing market rate? It's what's the ongoing market, how much the investors wants to earn given this market, given the risk of the stock. So the market rate is something that the investor determine for themselves. It could be 8%. It could be more than 8%. They want to earn more, or they want to earn less. And this is important because when you buy this bond, the bond is telling me, the company is telling you, I'm paying 8%. Well, you could say, well, that's not competitive. I want to earn more. Therefore, if I want to buy your bond, I'm going to discount your payments based on my market rate. I'm willing to offer you a certain amount. If 8% is more than the market rate, you will discount based on the market rate and even pay more for this bond. And we're going to see later on shortly how do we do that. But the first thing to do is let's find the price of the bond. Illustrate what we just learned about, how to value a bond. For the sake of illustration, I'm going to assume my company, Farhat Inc., issue a bond with the following feature. I want to borrow $1,000. I'm willing to give you $80 as a coupon, which is 8%, coupon rate 8%, and this bond is for 10 years. So you give me $1,000 today. Every year I'll give you $80 and give you your $1,000 back. Okay? So the yield to maturity initially is 8%. Again, don't worry about what yield to maturity is. We'll talk about that later on in a separate recording. Okay? This means the bond pays $80 for 10 years, then $1,000 at maturity. Okay? The yield to maturity is the market interest rate required by the investors. Now we're going to assume that the investor also wants to earn 8%. So notice here, the market rate is 8%, which is the same thing as the yield to maturity. Another word for market is yield to maturity. You're paying 8%, and the market wants 8%. The market means the investors want 8%. Let's find the price of the bond. So step one is to discount based on 8%. Let's discount the present value of the bond. Hopefully you remember this. We'll take the payment, which is $1,000, divided 1 plus r raised to the t. The $1,000 divided by the present value factor, 1 plus r, the interest rate 8%, raised to the nth power or to the t power, which gives you a factor of 2.1589. 1,000 divided by that, assuming you're using the formula. This part of the bond by itself, this $1,000 by itself, you're paying for it today $463.19. And this $463.19, if you let it grow at 8%, you will get your value in 10 years at $1,000. So what we did now is we valued the lump sum payment by itself. Is this the only thing you are buying? No, you're also buying because the bond comes with the payment. Then you discount to find the present value of the coupon payment. Now this is the long formula for the present value of the coupon payment. You could use the time value of money, or you could use this formula, which is you'll take C is the payment, $80, you multiply it by 1 minus 1 divided by 1.008, the interest rate raised to the 10th power, divided by the interest rate. So if we do so, we'll take $80 times 6.71 02, which is will give you these payments by themselves are worth $536.81. Now I am not going to do the proof. I'm not going to do the math calculation for you because I did so when I showed you the time value of money. I know I keep repeating this because the assumption here is you are comfortable with the time value of money and the present value of an annuity, the present value of a single payment. And this is what we just did. And when we combine those two together, the face value and the face value of the lump sum, the face value of the payment, they'll give us $1,000. What does that mean? It means you should pay for this bond, assuming you want to earn 8%, exactly $1,000. Now, why do you pay exactly $1,000? Because if you go anywhere else, you are going to earn 8%. And this company is paying 8%. So, because the coupon rate equal to the yield to maturity equal to the market rate. So we have, don't confuse those two 8%. One of them is the market or the YTM, and the other one is the coupon, but they happen to be the same. If they happen to be the same and we perform our computation, the bond will equal to exactly $1,000. Now, let's take a look at this multiple choice question from farhatlectures.com. And this question basically tests your knowledge about the basic terminology of bonds. Which of the following options donates the amount that a bond issuer pays the bondholder when the bond reaches its maturity? So which term determine when the bond reaches its maturity? Okay, face value, coupon, maturity, or coupon. What's the amount of the bond issuer pays? What do they pay when the bond reaches maturity? Now, if you might be saying, hold on a second, it's easy, maturity date, maturity. No, maturity is maturity. It's maturity date. That's a maturity date. We don't know what maturity is because it could be maturity date, maturity value. So it's not maturity. Is it a coupon? The coupon is the dollar amount that you get. Like, for example, $80 every 6 months or every year, depending on the bond. The coupon rate is a percentage. The coupon rate determines the coupon. You don't get the coupon. The coupon, you get them as the bond mature, not at maturity date. At maturity date, you get back the face value. And remember when I talked about the face value, I said, think about what? Think about the $100. The $100 will have a face value. So the bond, you will get from the bond the face value of the bond, which is the amount printed on the bond, which happens to be whatever that amount happens to be. It's called the face value. It's called the maturity value, not the word maturity. If we say maturity value, those are the same. Also, another word for it is the, you guessed it, the par value will be also a correct answer choice. So par value, maturity value, face value, they all mean the same thing. What should you do? Now you want to go to Farhat Lectures, look at additional resources, whether you are in accounting, finance, CPA, CMA, CFA, or studying for a professional certification. Invest in yourself. That's the best investment you can make. Good luck, study hard, and of course, stay safe.